Welcome back in YouTube. Today we're going to talk about Kohls. Now this one has absolutely fallen off of a cliff. If you're not familiar with ticker symbol KSS, it is down roughly 20% today, over 20% at one point. It got the rug pulled from underneath them.
These nuts. Got him. Got him.
So Kohls was going to be acquired by Franchise Group, which is kind of like a wannabe Berkshire Hathaway. They're buying up small businesses and they sell off the aspects of the businesses that don't outperform, build a business within that business. In short term, that's kind of what they do. Now they entered an agreement with Kohls to buy them for $64 a share, roughly 80% above what the stock was trading for, and now they backed out of the deal and Kohls collapsed. Is it a buy? Let's get into it. By the way, if you're new to the channel, welcome in, consider subscribing and smash that thumbs up. So as we can see here, we have a target price of $52. And basically, the downfall with Kohls is revenue has been flat for 8 years. So it's just kind of just dead money sitting there minus the dividend. Now, I went through their quarterly report. There was some good things about the company going into January. Net sales were going to increase about 2 to 3%. Operating margins were going to stay fairly stabilized, and earnings per share were going to be pretty solid, about $7 to $7.50. Now this was in January before interest rates started rising and the consumer started to absolutely collapse. This goes to show, we're going to show you how fast the consumer collapsed and how outlook has completely changed for the retailers. Now when I went through their quarterly report, couple bonuses here, guys. First and foremost, they were approximately going to spend $850 million to expand the Sephora partnership, approved a 50-cent dividend. Now they pay right now, if the dividend can stay intact, they do pay a pretty hefty dividend of over 5.5%. And the bonus and the icing on the cake was the fact that the board approved 3 billion share repurchases, and the company planned to repurchase at least 1 billion in shares in 2022, of which 500 million is expected to be repurchased through the open market transactions. So they were paying a dividend. They had fairly stabilized margins, and they were buying back stock. Everything looked good. Consumer absolutely collapsed. Excuse me, this was back in March, not January, but consumer absolutely started to collapse, and the board pushed them when we started to see their stock flatline and even dip down. Sales go from being possibly positive to going to negative. Now the board pushed them to sell the business, and unfortunately that sale fell through. But as a whole, is this business still worth something? That's what we have to figure out as investors. Is there still some value here in Kohls? Just to kind of give you guys a recap of what I'm calculating here is, now they in their March quarterly report, they stated that they were going to do about 2 to 3% revenue growth. That has completely changed in a recent article. They're expected to have negative high single-digit growth over the next year or two. So what I'm going to do is I'm going to use negative 7% over the next 3 years of average growth for Kohls. After that, I'm going to bump it up to 3% and then 2% following. EBITDA margins are sitting right around 9.4%. I'm going to use 9 for the next 3 years, 10 for the year following, and 11% for 6+ years out. I'm expecting them to possibly grow their margins within their business as inflation should get under control. This should benefit big box retailers, but who knows? This is just kind of just me eyeballing this one, guys. This is why you have to be so careful when you're running analysis to not be biased in your opinions. Kind of go in with an open mind and use what you think are realistic expectations for the company. Now, one thing I will say about the company is they do buy back their shares and they do pay a dividend. They find ways to return capital to the investor. Unfortunately, with the stock price, it has not shown through their stock. Over the last 5 years, the stock price has been everywhere from $79 all the way down to about $14 during the pandemic. Came out of that and then rebounded back into the 50s and now is at $28. Extreme volatility, trades at a very modest PE ratio of 4.6. When we look through history, I mean, we can see here that historically trading at low valuations, going from a forward PE of 10, 8 down to 5.8. Trailing PE is sitting right around 6. Enterprise value sitting at 11 billion. So I have a lot of mixed feelings with this company, as the largest retailer in the US has 1,150 locations, and it does have some assets here that I find interesting. Is shopping going to go away? Probably not. Now, mainly, I think most people do their shopping online, but some of these big box retailers should make it through, even through recessionary talks. So as we know, the growth is going to be the biggest knock on this company. Now, it already gets about a D rating for growth. Now we factor in negative growth over the next few years. Obviously, this is not a good outlook for the company. And while the dividend safety is at a B minus, paying out about 22%, we can see that a couple years of negative growth and eating into the cash flows and eating into possibly their cash position could impact dividend. We could probably see the dividend get slashed in the next year or two if things don't turn around for the company. So I want you guys to understand, while today it seems that the dividend is safe, we don't know what tomorrow brings. We don't know how impacted their sales are going to be. They could absolutely come back out and state that the growth is going to be negative double digits, or it could even come out and say that the growth is going to be flat. If growth becomes flat, guys, this is a very interesting stock here. So guys, just running my numbers throughout the next few years, I think this stock could be worth about $28 in 2030, which means that in order for me to get an internal rate of return of about 12 to 15%, I need to be buying the stock right around $11 to $12 a share. As we can see here, fair price around $11. Now, here is the caveat, guys. If over the next few years, if they can turn this around and make their earnings go to the positive, even if it's only a 1 to 2% gain, you're looking at a $39, $40 stock, and a $15 price tag today would seem appropriate for a stock that would be worth up to $40 in 2030. Now, guys, this is just my opinion. This is me just running my numbers. But as we can see here, it is a very interesting stock when we factor in if they can keep the dividend going and they still maintain to buy back their shares, and they still maintain a strong cash position, and they still can make some of these assets perform. Now, what the plan was for Franchise Group was they were going to sell off the underperforming assets and just focus on high-end areas and building more areas in higher-end places to where their return on capital would be much greater. Now, this is something that Kohls can execute, but I think they were just so focused on selling their business, everything kind of went to the hip side, which tells me that they could be in for another few rough quarters. That could be a buying opportunity at some point in time. As we can see here, you have a high of $71 price target and a low of 32. Obviously, I don't think this is incorporating the deal not getting done and positive and negative possible growth here on the horizon. But with that being said, I think it's probably sitting right around fair market value today. And in order for me to even get excited about it, it probably needs to come down about 50%, putting it right around a $14 to $15 stock. At that point in time, I'd reevaluate the numbers. Hopefully the next quarter, I can get some more understanding of what's going on with the company and reevaluate it from there. As always, guys, hopefully you enjoyed my dive into Kohls. We will see you next time, investors. Peace.